So you said that you kind of added like, reflecting that everything's going really well.
Yes. I want to use a P. That's going to result in a higher growth rate. And in effect, the PE ratio should fall from the growth rate, follow from it. So I want to use a growth rate that's reflecting a bull market, a PE that reflects a bull market. Yeah, essentially everything's going great. Not we're at the bottom of a cyclical recession or something.
And why not sort of choose like a middle of the road one rather than...
I'm looking for really how big's the pot of gold? What's a reasonable number I could put up there for the size of the lottery?
Okay.
All
right.
I'm using a historically reasonable current earnings number, growth rate. Oh, sorry, that's the actual earnings. I'm using historically reasonable current earnings, meaning if the earnings are $4.21 per share, that's not an aberration. It's not really low. For the last 20 years, they've been at $8 to $12. Or it's not really high. For the last 10 years, it's never been over $1, and last year it was $4.
I'm using a historically reasonable current earnings number.
Yep.
Yeah. Okay. So that's basically like, again, it's like throwing out the outliers. Like if it's crazy because of something happening, like this year might be a crazy year for earnings for a lot of companies. You would maybe take that out if you think that the pandemic isn't going to come around again.
Right on.
Okay.
All right, number 5. I'm using a conservative minimum acceptable rate of return. MARR. Minimum acceptable rate of return. That's reasonably conservative. In other words, the lower the minimum acceptable rate of return, the less conservative it is. The higher the minimum acceptable rate of return, the more conservative it is. I know that doesn't sound intuitive, but that's how it works. Because this minimum acceptable rate of return is our discount rate. It's what the rate of return we expect every year from this investment's cash flow. And so I'm using something that's pretty conservative. I use a 15% minimum acceptable rate of return. And I can tell you with a high degree of assurance that right now, Wall Street is probably using an 8 when they do this kind of stuff.
I'm using a conservative minimum acceptable rate of return. So I always use 15% because that's what you use.
Yep.
What would make you change from that 15%?
The only thing that would make me change from 15% is if I
and by change, I guess I mean like go higher because you say stay conservative.
Oh. Well, 15% is conservative. I mean, that's a beast.
Although, I guess you could downgrade it and still be conservative with some.
I mean, like I said, the only thing that would make me change off of that is if there was a permanent change to the 10-year T-bill in my lifetime. It will never be above 1%. Then I will start reducing that. Yeah.
Well, it's possible.
It's possible. I mean, good Lord. 140 years of investing experience is being challenged every day by these Federal Reserve central banks.
Totally.
So, brave new world a little bit.
Okay.
All right.
I'm
so there's
using
that
a
one.
conservative minimum acceptable rate of return, figure out what's conservative for that situation and adjust it accordingly.
Yeah.
Okay.
And basically use 15%. That's what I'm doing. All right, number 6. I've factored in the cyclicality of earnings and cash flow. Cyclicality. I don't want to use an earnings number or cash flow number that's not factoring in cyclicality, which is sort of a little bit of a duplication there on long-term growth rate for earnings are actually the earnings number are all affected by cyclicality. So if Facebook isn't cyclical, so I can use I can probably use last year's there, but CF Industries is highly cyclical. They do fertilizer and it goes up and down. So I've got to choose a number here that is reflecting that. That's all.
And when you say factored in, so that means just basically like adjust the number. So
adjust it up or down.
Okay.
Yep.
I've factored in the cyclicality of earnings and cash flow. And I'm putting in parentheses, adjust the number.
And since we're using earnings here, never mind, scratch this one. Next one, the business price has a margin of safety compared to the business value. In other words, when we calculate our margin of safety price, we are getting a large margin of safety. And
the business
large,
price, when you say the business price, what's that?
That's the margin of safety price we just came up with when we ran the calculation.
Oh, okay. The business price in this equation has a margin of safety compared to the business value?
Right. Now, when I do it, I'm going to get a 50% margin of safety. I'm going to get a number that is exactly like I'm buying a $10 bill and I'm paying $5 for it. That's the number I'm going to come up with. So when you do this, just make sure that you are getting a large enough margin of safety that you feel confident in buying the company. I don't think Warren Buffett uses 50% anymore. I think he used to. But I've seen Berkshire step in and start buying companies with less than a 50% margin of safety. In fact, just recently, they started buying more Bank of America, and there's no way that's at a 50% margin of safety right now, in my opinion. So it just, this is for you as a checklist to put the numbers in where you want them. When I put them in, I'm looking for 50% discount.
When you say business value, does that refer to something that's a separate calculation? What do you mean by business
in this
value?
Calculation. Business value is what we're going to come up with here when we do this.
You mean the full price, and then you're saying
the sticker price.
The end price is the discounted price.
Right.
That you're then using a margin of safety to cut down.
Right.
Okay.
Right. So if I come up using this calculation, I come up with a sticker price of $100 a share, then I'm going to buy it for half of that. That's just my way of doing it. Buffett is paying more. He's paying maybe a fairer price than that in this market with this one stock that he's buying. So that's going to be up to you, but for me, it's 50%.
Okay. So this is a reminder to cut it in half or cut it in thirds or cut it in whatever's.
Yeah, make sure you have one.
Okay.
Right, exactly. And so now you'll do the calculations, and the calculations are in the book Invested. They're in the book Payback Time. They're in the book. They're in the.
They're in rule number one.
Rule number one. But just to run through it really briefly, you essentially grow the earnings at the growth rate for 10 years. Then you multiply that earnings that you arrived at. Let's say you start with $10 of earnings and you grow them for 10 years at a certain growth rate, and you end up with $100 of earnings 10 years from now. Mm-hmm. Then effectively what you do is multiply those earnings by your multiplier, your PE ratio down the road. And let's say it's 40. So now you got 40 times 100, or 4,000 is the value of the business in 10 years. Now divide that by 4, which is a 15% per year discount. Divide it by 4 and you'll come back to $1,000. That's the sticker price or the business value. And then divide that by 2 and you get $500. That's what you should pay for it. So don't worry about those numbers making sense, but you just get the general idea of how the math goes.
That was a good short little explanation.
Thank you.
Okie dokie.
And then finally, I am confident enough in this valuation that I would put 20% of my net worth into this one business at this margin of safety price. You guys, if you enjoyed this video and you feel it was valuable in teaching you more about how to invest, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen. We got a free gift for you. Thanks again for watching.